Hello, everyone. In this lecture, we are going to talk about revenue recognition. So what is revenue recognition? So when you're using the cash or accrual basis, revenue recognition is going to impact the income statement. So we're focused on accrual accounting because we're dealing with publicly traded companies, and all publicly traded companies are mandated to use the accrual basis for recording transactions. So if you look at Netflix, right, this is their income statement for 2020. They had revenues of $24 billion. So what does that really mean, right? Does that mean all of this money from Netflix, my annual subscription, is located in there? Well, not necessarily. So if you purchase a subscription for $15 a month, how is that revenue recognized, right? So remember, with revenue recognition, you can only record revenue when services are rendered. So since services rendered on a monthly basis, Netflix can only recognize $15 of each subscription each month. So where does the remainder of the money go? So it sits on the balance sheet called under an account called deferred revenue. So that $15 that's being recognized on the income statement, the other 11 months of that $15 sits here until each month passes. So this is the standard for revenue recognition that all companies, publicly traded companies, must abide by. You identify a contract with a customer for whatever goods or services that you're going to provide, identify the performance obligations, determine the transaction price, then allocate the transaction price to the performance, and then you recognize the revenue. So in sum, this means that the revenue can only be recognized once services have been rendered. So here's an example of revenue recognition for a service or a product that is subscription-based. I have an annual subscription that I sell for $120. So on my income statement, in January, I will record $10. In February, the $10, March, April, May, so forth and so on. Only $10 each month. I cannot recognize the $120 upfront because the services are for a length of time. So if I were selling shoes and I sell it to the customer for $50, I would recognize that all in January, right? Because I have provided the services of products and goods to the customer. Another example, if you sell a 6-month subscription for $6,000, you have to break that out over 6 months to recognize that revenue. And again, if I sell shirts and I sell 10 shirts for $5, that's $50 that I can recognize in January because that's when they were sold. That's when a transaction between myself and the customer took place. So revenue recognition is recorded when, very important, when a product or service is delivered, right? So on a subscription basis, revenue is recognized over the time of the subscription. If it's a 3 months, if it's a 6 months, if it's 2 years, right? You take whatever that annual subscription is and you divide it by the number of months of the subscription. When you have a product or a service, when it's delivered to a customer, as the example with, I sell sneakers or I sell t-shirts, I recognize that revenue immediately. In the airline industry, well, you book your flight today, but you book that flight to fly out in 3 months from now. The airline industry cannot recognize that revenue until it provides you the service, which is when your flight takes off. Construction projects can be recognized in phases. These are fairly large projects. And again, there's a contract made between, you know, the builder and the customer, and they say, okay, this is going to be milestone 1, and we will bill you 25%. So when that is agreed upon and that phase has concluded, then the construction company can recognize that 25%. And for gift cards, it's when merchandise is purchased with the gift card. So if I go to Fred Meyer and I buy an Apple gift certificate, there's no revenue yet for Apple. But when I give you that card and you go to the Apple store and you buy something, well, now Apple can recognize that revenue. So revenue recognition, it's a part of the GAAP principles, and it must be used by all public companies. So whatever type of a company has, they must abide by these rules. And think about Amazon, right? So they're selling products and goods and services that are shipped out to the customer, and you know that's when they can recognize revenue. But they also have Amazon Web Services, which that revenue would have to be recognized differently. And revenue is only recognized when it has been earned.